All right, so hello. Um, it's Thursday, the 24th of February. You'd think that would just be a normal day for all of us, but unfortunately it is not. Ukraine, the whole incident and thing we've been watching in the news over there has finally happened, and Russia has invaded Ukraine. Now, we distinctly need to be paying attention to what is going on over there. In fact, in case that it does pick up and become something more severe. But I did want to just reach out and give you a short little video of what I expect and where we're at in relation to that, plus all the other nonsense that's been going on in the world in terms of like inflation and everything else and how this all plays together. Not a scripted video. This is literally just me kind of been thinking about some thoughts and wanted to tell you where I think we're at and what we've got going on. So first, I'll tell you this: the markets as a whole, we are officially into what's called a correction. Now, a correction is a 10% or more drop. We are not in a bear market because a bear market is a 20% drop. So we're in a correction, but not a bear market. We're positioned for this. We knew they were going to come. We expected it. In fact, typically a correction happens about once a year. So this is not unusual by any means. It's fairly normal. Obviously, Ukraine and 7% inflation rates don't happen every year. But what we're seeing in the market right now is fairly normal at this point. Just to give you an idea, even at this point in the day, it is 230, and the S&P's down about 1/3%. That's all. So we're down, but we're not down a lot today. It was down almost 2% earlier, but it's kind of picked itself back up. Where I really see a concern with where the market could be going in the future versus buying power, and these are really the two things that are balancing each other out. The Federal Reserve really wants to work on inflation and get inflation down, but in order to do that, they have to take money out of our economic system, and if they take money out of our economic system, then we'll probably go into a recession. So the market as a whole now is being down 10% before they've even been able to do any tightening policy. We call it tightening when they either raise rates or stop the quantitative easing or QE that they've been doing. When they stop doing these things and they try to raise rates and they try to tighten and add a tightening policy to what we've got, that tends to slow down the economy. Well, if the market's already down 10, 11, 12, 13%, the question becomes, do they really want to still slow the economy down? Now, the hope would be that the market drops we're seeing are slowing down inflation, and then there's now less need for the Fed to tighten. The concern is it's not slowing down inflation, and now we have high inflation and a bad market, and it puts the Fed in a place where if they continue to raise rates, it may not be as beneficial because of the economic downturn that it would cause. So I'll tell you, we're right where we were for the past 2 to 5 years, I would say. One of two things is going to happen. We're either going to go into a recession and the bubble's going to pop and you're going to see it, or we're going to see continued inflation and the bubble's going to pop in currency and the dollar's going to lose its value and you're not going to see it as much, but it'll affect either way. We're probably going to see that overall, after inflation, we're going to see a little bit of a recession, whether it's classified as a recession or not. Now, Ukraine is obviously a whole nother situation. What I will tell you is if you look at the history of the markets throughout some of the most devastating wars we've ever had, World War I and II specifically, you still find that the markets go through these things. They come out the other side. So even if it goes to the worst case scenario, there's a bright side when it's over. The bad side to it would just be having to suffer it out. So for those of you who are in retirement, I would say think of a couple things. First, think about the fact that you're not taking all your money out today. Even if you're retired and you're pulling a little bit of money out every month to live off of, you're not taking it all out today. You're taking some of it out every month. So if you've ever heard of the phrase dollar cost averaging, it's where you put a little bit of money in over time and all those little monthly purchases average out so that you're buying both highs and lows. It works the same way in reverse. You can dollar cost average the money out of the market. So every month a little bit of money comes out, and if there's a drop in the market, you're taking some out, but as the market grows back from it, you're taking it out then too. So it'll average itself out. The key is if we do see a drop in the market, we want to make sure that we're not pulling out more than we need. So maybe either living off of cash or living off of other sources of income could be important for a little while if we do continue to see a market drop. If you're not in retirement yet and you're not more than you're more than 5 years is what I want to say. So if you're more than 5 years till retirement, then you're in a much better shot, because market drops don't mean anything to you other than there's a sale on stock, and that's when you want to buy. So if you're sitting on cash and you're in your 30s, 40s, even 50s, it's probably a really good idea to just say, let's take some of this extra cash that we don't need and let's dump it in the market at this point in time, because you'll have the opportunity to buy it at 12, 13, 14% below value of what it was just a couple weeks ago. And the values don't change that much. They might have been a little high then, maybe they're a little low now, so it averages out a little bit. But all in all, if you're not in retirement right now, there's probably not a whole lot to worry about. All right. One other thing to think about is alternative investment sources, things like Bitcoin, oil, and gold. These are things that anytime there's market turmoil come up, people want to buy Bitcoin. Well, I will tell you to look at the chart of Bitcoin and see the volatility that's in it. And this doesn't mean you don't want to own Bitcoin, but Bitcoin is not the protection against inflation people want it to be. Bitcoin is not the protection against market downturns that people want it to be. It's actually a very aggressive growth play. So if you're buying Bitcoin or any other kind of cryptocurrencies, realize that it's going to be really volatile to these geopolitical and inflationary concerns. Inflation's going to push it up. Geopolitical concerns will push it down. Okay, it's not going to be a steady, safe place to just put money and let it grow. It's not a currency. Even though the word currency is in the name, they're not a currency because they're not stable enough to be a currency. They're too volatile. Gold, oil, silver, gold and silver. There's a lot of gold and silver hawks on the radio and on TV right now saying buy gold, buy gold, buy gold. Yeah, it's okay. It's not a bad idea having a portion of your portfolio in these things. If you would like to, we can talk about some ways to do that. Same thing with real estate. It's not a bad idea to have a portion of your portfolio in real estate. But the thing about gold and silver is if you're just sticking gold coins under your bed because, one day the economy is going to collapse and you'll have a pile of gold coins, no one's going to want your gold coins if that happens, because they're going to be worried about food and ammo. Those would be the things people want at that point. Same thing with like oil investing. Oil is most likely going to continue to go up. We're up to about $105 a barrel at one point today, so it's going to probably continue that trend. We can diversify into a little bit of oil stocks, but most of my clients, and this video is mostly for clients, I may let some people who aren't clients have access to it, but my clients, we've got exposure to all those things. So into all those oil stocks and companies like Exxon and such. So we do have that there, and it's part of your portfolio. That being said, I did, for some people, make a few moves today. If we were sitting on a little bit of extra cash, we put it in. If we had some rebalancing to do, I had some people who were sitting on some pretty good capital gains. So those have obviously shrunken a little bit, and I wanted to make some moves, and I was waiting, so we made some of those. If you want to know if there's anything specific to do to your portfolio, let me know, and it's my desire to. It's tax season, so I'm doing a lot of tax work for clients right now. So if I don't reach out to you, please reach out to me, and we'll be happy to talk about it. All in all, I mean, it's normal what we're going through right now. These type of things happen about once a year to have a correction, and about once every 5 years to have a bear market, which is a 20% or more drop. We haven't had a bear market in over 10 years, if I remember correct, was the last 20% drop. It may have actually officially hit 20% at one point during 2020, but that was more of a panic for just a couple days. It didn't stay down long after COVID. So if you have any questions, let me know. I'm more than happy to reach out to you. This is the quickest, most efficient way to get a message out to everyone, so that's why I wanted to do it. I know it's not personal, it's not one-on-one, but I feel like it's actually better than typing up a newsletter to you, because I like to watch videos as opposed to read them, as opposed to read articles. So if you have any questions, reach out to me. Let me know. I'm here for you. This is why you have me in place. If you know anyone who has any questions or is worried or needs help, tell them you got a guy, and please send them over to me. I'll take good care of them. Otherwise, have a great end of February, and hopefully March will be a little bit warmer.